Okay, sorry about that. I lost track of what I was doing. Okay, now we're going to do an VE, or the entity method, with known market values. So I'll show you what that means in a sec. P for parent wishes to acquire 8,000 of S sub limited shares in order to obtain substantial synergies from the proposed acquisition. So the parent estimated that 100% acquisition was not needed to the synergies because they could obtain control and take control over their decisions without 100%. So they figured that more than 80% acquisition would be too costly. So parent then offered all of S's shareholders, remember you're buying the shares from the shareholders, a premium price % of the outstanding shares. To induce a sufficient number of shareholders, the parent needed to offer $9 per share, even though the shares had been trading at $7.85. During the weeks that followed the acquisition, the 20% NCI shares continued to trade at $7.65 to $7.85 range. So we want you to calculate NCI and goodwill. So 8,000 shares, and they're buying 80%. So, okay, what do I want to do here? Tell you about the wording. So notice here is every other share is trading at $7.65 to $7.85, which we can't use two numbers, so we'll take the average of that. Which is $7.75 per share. Okay, so that's our little story. Now, they bought 8,000 shares. How much did they have to pay for 8,000 shares? How much were those? Those were $9 per share. Because remember, they had to offer them a little extra to get them to give up their shares. So these non-controlling interests stayed in that range. So notice here, up here we said, to determine the fair value of NCI, we will either use the share price of NCI shares if given. So they are given, and they are different. They're going to be different than the price they had to pay to get control. Okay? So when you these two different share prices, that's when you know you're doing the known market values instead of implied. Okay? And I'll compare the two examples after we're done them. Okay, so let's go to page 3. And I am going to calculate this in one column. Calculate goodwill. But Exhibit 4.5 in the text shows goodwill calculation in 2 columns. You do that when the shares are different prices. Okay? Controlling interest and NCI. So you guys can look at that. You're going to come up with the same number anyway. I prefer the single column. It's less confusing overall. Okay? So let's just look at our little balance sheet. Here's the parent, here's the sub, here's the carrying amount, here's the fair. Okay, so notice that they're going to present information in different ways, so kind of have to get used to it. Now, this is the balance sheet we're working with. Without looking at the dates on the last page, is this before or after the acquisition date? Okay, what account would we put if the parent had already acquired it? So on acquisition, parents' books, what entry do we usually make? Well, what's the parent giving away? Cash, for however much. And what are they getting? Well, who are they paying? They're paying the shareholders of the sub. And what are they getting when they give them the money? They're getting shares. So do I debit common shares? No, because they're not our shares. They're S's shares. So what do I debit? Investment. So looking at the parent's books, because that's actually on the parent's books, do I have an investment account with the assets? No. So no investment account. Entry above has not been done. Okay. Now, let's see what's happening with this balance sheet. Okay, so fair value of cash is the same as the carrying amount. Does that make sense? Yeah. Fair value of accounts receivable? Yeah. Generally, you wouldn't difference in those ones. Inventory, could you see things differently? Yeah, so what happened? Inventory actually went up by 2,000. Now, you don't have to do this, you guys. I'm just showing one way you can do your work, but you can do lots of different ways. Okay, what happened to the plant? It went up by 9,000. It went from 50 to 59. And the patent went down by 1,000. Current liabilities are the same. What happened to long-term debt? It went up by 3,000. Okay, so this here, what I've just done here is the FV minus CV. Sometimes they just show this separately. Okay, so we determined the acquirer because it was the parent acquiring the sub, and that's just all there is to it. They paid cash and bought shares, so we're good. So now let's do goodwill and acquisition differential. So calculate goodwill and acquisition differential. And remember, we're doing this at 100%. So we're adding both our part and the NCI. So know exactly what the fair value of the total sub is, because they told us. And remember, this is the FVE method. So we need the 100%. So we know, how much did we pay for our 8,000 shares? $9. And the NCI shares just sat there at $7.75, and that was the average price. So that works out to $87,500. And that's the fair value of the total sub. That's kind of new. When we know what our shares were and what the NCI shares were, that's what we start with. Then we take away the SCV of net assets. So that's the subs, net assets at carrying value or book value. Okay, so we take our assets minus our liabilities. So assets minus liabilities. Assets are 100,000. Liabilities are 30,000. So you guys, sometimes in the text they get carried away, especially in chapter 3, skipping this step and doing it the shortcut way, okay? You can always do calculations, but if you are asked, especially in chapter 4 on, to calculate goodwill, you have to do it split up this way, okay? Because once we hit chapter 5 and statement, we're going to see how the pieces flow. Okay, so that's 70,000. Now, I have one little question for you. What if we didn't give you assets and liabilities? Or let's say it was a big long list of assets, a big long list of liabilities, didn't total them. They just gave you a trial balance. What can instead of assets minus liabilities? What assets minus liabilities, what else is it equal to? Assets minus liabilities equals, you learned this way back, equity, right? So you could look at your equity and just take common shares plus retained earnings, and you'd get 70. So common shares plus retained earnings, the same. So sometimes they don't give you a full trial balance. So you're actually missing the total assets and total liabilities. So you just take your equity. Does that make sense? So that's 40 plus 30 equals 70,000. So just watch for that. Sometimes it can save you a lot of time in adding. Okay, so we subtract that. We get 17,500. And that's called acquisition differential, or just. Now, what do we take off from that? We take away the fair value differential, or you can just call it FV minus CB, because that's what you're actually doing. So take a little pause, you guys. You know how to do this. List all the differences between fair value and carrying value on inventory, plant, and so on. Figure out what the numbers are, and then debits and credits. And then I'll just go over it all. So just hit yours on pause, try and put those 4 things in, and let's see where we are. Okay, I'm assuming you are back. So there's 4 items up here, 1, 2, 3, 4, that need to be listed here, where the fair value and the carrying value. So we're going to take inventory, and I'm just copying them in the order. It does not matter. Inventory, plant, patent, and long-term debt. Now, the differences I've already calculated, okay? But I'll just write them down in case you're a little confused. 22,000 minus 20 is 2,000, not 20,000. And in going up, remember, don't put in your pluses yet. The plant went from 50 to 59. So it's also going up by 9,000. Patent is going down. So fair value is 10 minus 11. It's going down. And long-term is going up. 25 minus 22 by 3,000. So our little rule for ourselves was debits equal positive and credits equals negative. So to make inventory go up, do we debit or credit it? We debit it, so it's positive. To make plant go up, we debit it. To make patent go down, well, we've got to credit it. And I encourage you guys to practice bringing the negative signs. Long-term debt. Oh, it went up, so it's a debit, right? No, to make long-term debt go up, it's a credit. Okay, I'm just going to recap. Debits are positive, credits are negative. To make inventory go up, because it went from 20,000 to a fair value of 22, went up, we debit it. Same with plant. Patent, however, went down, so we credit it because it's an asset. Long-term debt went up. To make debt go up, we credit it. So it's negative. So we total that up, we get 7,000, which takes us to 10,500, and that is our goodwill. Because don't forget, it's less, 17.5 less this gives us that. So after AD and goodwill, we said the second thing we have to calculate, my goodness, is NCI. So NCI at acquisition. Now, I'm going to flip back here to page 2. Fair value of NCI portion. So the value of the NCI shares, if different from CI controlling interest share price or the implied value. Do we know exactly what the worth, both types, the controlling interest and NCI? Yeah, because we were given two different share prices, the $9 and the $7.75. So now we're using this. So all we need is the fair value of NCI shares. I'm just going to put because two share prices were given. So NCI is a non-controlling interest, so it's going to be the smaller number. 2,000 shares times 775 equals 15,500, and that's going to go into equity section. And then you'd go through and do consolidated statement, but I'm not going to do it on the, I'll do it on the next one. Okay, so when you're doing this on any exam or question, the first thing you're going to double check is that your calculations here were right. Goodwill affects everything, and in particular where people kind of mess up is here. It's really easy to get one of these backwards and then it changes your whole number. Okay? So just be careful when you're doing this part in particular. Double check your numbers. Okay, so we just did one where we knew both share prices. We knew NCI and we knew ours, and they were different. So we could truly calculate the fair value of the total sub because we knew what the two pieces were worth on acquisition date. However, we don't always know that. So on page 4, actually we're not going to do it right now. I'll start a new video, but then we'll go to page 4 and do look at the other one, the implied value.